Nick Paulson, he is India head with Espirito Securities. He joins us live from our Mumbai studio. Nick, fantastic to have you back. Thank you for joining us. Look at the macros we are working with. Growth is likely to go down. Reserve Bank of India is determined to increase rates. Earnings are likely to be noisy. Crude is at a 14-month high, but Nifty is still marching towards 6,000. What's going on?
Well, I think it's still generally the sentiment in the market is that we're in a gradual grinding recovery in terms of Indian overall economy and overall corporate earnings growth. I think expectations of both GDP growth have been coming down. I think the range now, most commercial forecasts have got sort of 5.5, 5.6% GDP growth, and earnings forecasts were sort of 10 to 14% the range at the beginning of the year for FY14. They're now probably high single digit, but it's still the sense that we're in a recovery. And also I think it's worth remembering that all of the major emerging markets, all of the BRICS, face structural constraints on growth at the moment. And so despite all of the issues when we sit in India focusing on the negativity, that actually most investors are looking at it in relative terms, and India still has some relative attractions. And I think as long as you're careful and where you're picking stocks, you can still make money.
So would you then, Nick, bet your money on any of the FDI contenders, and especially names from the telecom space which have gotten a go-ahead, Bharti or Idea?
I think you have to be careful betting on or playing just regulatory news. But I think it's a good thing overall. It's good for sentiment. But we've learned in the past about FDI approvals. When the government's panicking about the rupee pushes through FDI, you have to watch the implementation. Often it's slower than anticipated. And specific to the listed stocks, I don't think it moves the needle that much for the main listed stocks. However, I think structurally, if you look at the telecom sector, which has been very competitive, a lot of price pressure historically, it looks more attractive, particularly in terms of the top three. So I think Bharti, Idea and Vodafone are taking market share. Pricing is improving mildly, but you've got the challenge, I think, ongoing of the reason we prefer Bharti to Idea is that you've got a lot of spectrum auctions coming up over the next 2 years, which I think 70% of Idea spectrum's up for auction. So for us, I think we prefer Bharti. I think the second tier firms, this benefits people like Reliance, but structurally they face very serious challenges in competing against the top three as they take market share. So I think fundamentally I don't like Reliance Communications, but yes, it benefits from this move today.
Nick, what spooked the markets yesterday was the following. The Reserve Bank of India will suck out liquidity, interest rates could move up, that will have an impact on consumption, that will have an impact on demand. If the big picture argument is negative for consumption, why are consumer names doing rather well?
I think it's the familiar trend of overall, if you look at the drivers of the Indian economy, of the investment cycle, consumption and government spending, the most robust of those three pillars has been consumption. So overall, there are pressures on consumption, no doubt, but it's remained robust. And then secondly, remember, people, particularly foreign investors, have been nervous about the macro environment in India, which has meant they've hidden in reliable defensive sectors, and those have tended to be private sector banks, consumption plays, IT, pharma, etc. And so that's why, there's just a disproportionate focus on those sectors in a time of uncertainty and great weakness in some of the other investment-sensitive sectors. Look at industrials, look at real estate. These sectors are, to a great extent, uninvestable at the moment, which is why people are focusing where they are.
Is it time to have more like a middle-of-the-path approach now? Avoid buying into traditional consumer or FMCG names. They are wildly expensive. It's too early to buy growth and value stocks, but maybe buy into utilities, maybe time to buy into telecom, because A, telecom and utility stocks are not expensive, B, they enjoy pricing power, and C, if the economy recovers, they will be the direct beneficiaries.
Yeah, I think you're right. I think you have to take a mixed approach. I've been on before and talking about our concerns around FMCG specifically. I think when you look at consumption, it's better to look at a broad basket of consumption. So, for example, recently, Titan has obviously had a difficult time because of the measures on gold, and the stock's fallen quite sharply. It's trading at 22 times earnings. It's a great business. It's a time like after a technical factor that's undermined the business, that's the time to buy consumption plays when they correct a bit. The kind of headline FMCG firms that are trading at 32 times earnings, it's just very, very difficult to look at that versus what consumer plays are trading at elsewhere in the world, in fast-growing emerging markets, in Africa and Indonesia, in Latin America and European stocks exposed to emerging markets is a very, very wide differential, which I think is dangerous. So I think you need to play quality, so good businesses, high ROEs, good competitive advantages, but you take a balanced approach, as you say. I think some of the telco stocks are looking better. If you balance that with a sensible exposure in NBFCs, in some of the private sector banks that aren't as expensive, or look better exposed given the RBI's move yesterday, alongside, still think pharma and pockets of IT, maybe not Emphasis, which is already run, but Wipro, smaller stocks like Persistent, there's still value to be had there. So you can still take a cautious, quality-focused approach and build a sensible portfolio.
Nick, what about banks? Because they've really taken it on the chin, especially after what the RBI had to say yesterday. Is the pain out of the system, or is it time now to start cherry-picking when it comes to the banking names, or do you think there's more pain left?
I think the pain depends on how long this measure lasts, because it's clearly negative, and negative for specific banks. If it lasts for a quarter, and I listened to a call from Dr. Rajan yesterday where he was indicating that that was the intention, but ultimately he shouldn't be speaking on behalf of the RBI. We don't know. It could be a quarter. My guess is it'll be a sort of 90-day thing, in which case it's negative on margins. If it persists longer than that, it's negative on both growth and margin. And so the obvious stocks are those that have high bulk dependency wholesale funding, asset liability mismatches, high loan to deposit ratios. So clearly, Yes Bank is a negative in that environment. Indusin, which I think was doing well, is a very good bank. Again, it's under pressure. Kotak likewise. And I think the more reliable banks, better balanced banks like HDFC results today, no doubt it'll be a consistent sort of 30% net income growth again. I think that's better positioned in an uncertain environment, because we just don't know how long this is going to last, and it is definitely a negative. And it is a sharp move, and I think overall, beyond the banking sector, it's also growth negative, what happened yesterday.
What is a good price point to buy into HDFC Bank? Because irrespective of good environment, bad environment, we know that they know how to manage growth. They're likely to deliver a strong set of numbers.
I think HDFC is, for my money, it's the best bank in India. It has been for a long time, and it will be for a long time. It has structural competitive advantages. If you look at its credit picking skills, its retail exposure, its ability to extend into third, fourth, fifth tier cities, I think all of those bode well for long-term growth. I think right now, I think it makes sense because of the volatility elsewhere, and there's immense focus on private sector banks. I think as a portfolio stock, I think one should own it if you want any exposure to the Indian bank system, and you trim and add depending on where it's trading within its band. I think because of relative attractiveness right now, it makes sense.
Nick, autos has been one space which is really sort of haggling with the production slowdown. Every now and then you hear about, production cuts as well, demand slowdown, and of course sales as well petering down if they are not on strike. Labor issues, that is. What's your sense about the auto space? Is it time to avoid this space, or is it a clear sell right now?
I think I think if you looked at IIP numbers, autos were down 9% year on year. So I think structurally and overall, it's under a lot of pressure. However, I think one shouldn't just write off the whole auto sector. I think you should look at autos as the four-wheelers, two-wheelers, auto components. Within that, it's always possible, I think, to find value. And ultimately, you're betting on, remember, these are consumption plays that if you looked at how China developed in its auto markets, when it hits an inflection point, which India is at now, the growth rate from there on was sort of 30% year-on-year growth rate. So I still think structurally there are many attractions to the Indian auto market. It's just right now, Tata Motors, for example, has a weak domestic portfolio, so that undermines it. But I think other stocks like, say, take a Motherson Sumi, which has made acquisitions in Europe, is consolidating those acquisitions, driving up margins. As those margins come up, I think it's exposed to the domestic structural growth, but it's not overexposed. Pricing sensible, and you can see 30% type CAGR from the stock. So I think you can find auto exposure, but I think overall, yes, structurally at the moment cyclically the sector's under pressure.
You've got a buy on two of the capital good names, L&T as well as Voltas. What makes you bullish on them?
I think our overall position on capital goods is that it's still very challenging. I think the investment cycle the recovery is probably still 18 months away. And so we are cautious on the sector. And what we're saying is if you're going to play the sector, L&T is the most diversified play. It's because of its balance sheet, because of its competitive positioning. It's taken market share over the last 18 months to 2 years. We think that trend will continue, so it's building its competitive advantages, which is positive in the long term, and it's not overexposed to any of the kind of just the weak capital-intensive sectors like power, highways. It's doubling its international order book, good exposure to the Middle East. So I think diversified play, strong competitive advantages. If you're going to put your money anywhere in capital goods, it makes the most sense. Voltaire, slightly different exposure, obviously, because you've got the room AC business, which we think looks good structurally, and we think in terms of growth rates, it's come through a difficult phase, and we think amidst those firms, it looks one of the most compelling.
Final question. If you have to make a basket of, let's say, only 3 stocks, a combination of mid and large cap stocks, which are the 3 stocks you would like to own in that basket?
Across any sector?
Across any sector, across any market cap.
Yeah, I think it's difficult. Honestly, it's difficult right now to do a 3-stock or portfolio, 1-stock portfolio. I think it makes sense to do a more diversified play just because of the levels of uncertainty. Having said that, I think you should maintain strong exposure to the financial sector. So I'd probably pick Mahindra Financial Services within the NBFC space. I think right now, I think HDFC makes sense, as I said earlier. And then maybe for the moment, within IT, picking Wipro, I think it's the best risk-reward profile amongst the large cap IT sector. And I think you've got the dynamic of dollar, dynamic exposure to the US recovery, and I think they're going to do better in terms of win rates in the upcoming quarters. Might not be a great quarter this time, but I think from Q2 onwards, numbers will look stronger.